So, it is February 19th, 2026. Yesterday, the markets closed, the spreadsheets were opened, and DoorDash dropped their Q4 2025 earnings report.
And it was a massive report.
It really was. And look, if you are still thinking of DoorDash as, just that app on your phone that magically summons a burrito when it's raining and you don't want to put on pants well, we need to talk.
Yeah, we definitely do.
Because you're missing the actual story here.
Completely. Because looking at these numbers, and especially reading through the transcript from CEO Tony Xu and CFO Ravi Anukonda, the company we're analyzing today isn't really a food delivery service anymore.
Right.
That's just the front end.
Exactly. They are
Yeah.
positioning themselves as and this is a direct quote, the operating system for local commerce.
Which is a bold claim.
It sounds massive, bordering on arrogant, honestly. So welcome to the deep dive. Today we're unpacking the press release, the financial tables, and that earnings call to figure out how a company that started with takeout is now managing global logistics.
And swallowing up massive acquisitions like Deliveroo.
Right, and deploying armies of autonomous robots, all while trying to keep Wall Street happy.
Which, as we saw yesterday, is a bit of a tightrope walk.
A very shaky tightrope. So let's just start with the headline numbers, because purely on scale, this business is getting enormous. But I want to be clear here for the listeners who haven't dug into the tables yet, how big are we actually talking?
Let's just look at the raw volume. Total orders for the fourth quarter grew 32% year over year.
Okay.
They hit 903 million orders.
Wait, pause. 903 million.
Yeah.
In one quarter.
In just 3 months. Nearly 1 billion times, someone pressed a button, and a human or a robot moved something from point A to point B.
That's nearly 10 million orders a day.
It is. It's staggering. And that drove revenue up to $3.96 billion, which is a 38% jump from last year.
Wow.
And if you look at the marketplace gross order value, so that's the total value of all the stuff people actually bought through the app, it hit nearly $30 billion.
Okay.
$29.7 billion to be exact, up 39%.
Okay, so the machine is humming, the scale is just absurd. But in earnings season, the stock took a hit initially.
Right.
Why? If you have nearly 1 billion orders, how do you miss expectations?
This is where it gets fascinating because it really separates the algorithm traders from the people actually reading the strategy. They reported earnings per share of 48 cents.
And the street wanted what?
The consensus was 58 cents.
Okay, so a 10-cent miss.
Exactly. And revenue missed expectations by about $29 million.
So let's unpack this. Was it a demand problem? Did people finally just get sick of paying delivery fees and decide to cook?
Not at all. The demand metrics, so order frequency, user growth, they're all at record highs. The miss is actually a cost and investment story.
Okay, explain that.
First, you had some short-term reality checks. Management explicitly called out severe winter storms, specifically storms Gianna and Fern in the U.S.
Oh, yeah, I remember those. Gianna basically shut down the Northeast for days.
Right. And in the delivery business, weather is this weird double-edged sword. People want to order more when it snows, obviously.
Usually wants to drive.
But if the roads are closed, you literally can't deliver. So those storms disrupted operations enough to cost them roughly $20 million heading into Q1 2026.
Got it. So that's a one-off hit.
Exactly. But the bigger factor, and the one that actually matters for the long term, is the heavy investment they are making to integrate Deliveroo and overhaul their technology.
Okay, let's talk about Deliveroo, because we covered this when the deal closed back in October 2025.
Yeah, massive deal.
Buying a giant European competitor is one thing, but making it work is another. Usually, these mega mergers are just a disaster.
Oh, absolutely.
You get cultural clashes, the systems don't talk to each other, growth stalls out. Is that what's happening here?
Surprisingly, no. And I say surprisingly because cross-border tech mergers usually are incredibly messy. Yeah. But Tony Xu mentioned on the call that Deliveroo is actually growing faster post-acquisition than it was before.
Oh, what?
Yeah, they're actively gaining market share in their key markets right now.
That sounds a bit like corporate PR speak, though. Everything is great, trust us.
I thought so too at first, until I looked at the actual contribution numbers in the tables. Deliveroo contributed slightly more than the expected $45 million to adjusted EBITDA in Q4.
EBITDA, so for anyone who needs a quick refresher, that's basically their profit before the accountant's taxes and interest payments get involved.
Exactly. It's a solid measure of raw operating cash flow. And for the full year 2026, they are projecting Deliveroo to pump in about $200 million in EBITDA.
Okay, so the business itself is healthy.
It is. But keeping it healthy is extremely expensive right now.
Why? If it's making money, why is it a drag on the costs?
because of what they call replatforming. And this is a really crucial insight for anyone interested in how these massive tech platforms actually run under the hood.
Okay.
Right now, DoorDash is effectively running three completely separate tech stacks.
Wait, three?
Yeah. You have the original DoorDash stack, you have the Wolt stack from that acquisition a few years back, and now the Deliveroo stack.
Oh, wow. So it's like three different companies pretending to be one app.
Precisely. Think about it like a railroad network. You have the U.S. trains running on one width of track, the Wolt trains in Europe running on a slightly different width, and the Deliveroo trains on a third.
That sounds like a nightmare. You can't just move a train from London to New York.
You can't. It's wildly inefficient. Engineers can't easily work across projects because the code bases are completely different. Data is siloed. So Tony Zhu announced a massive project to migrate everything onto a single global tech platform.
And I assume you can't just copy-paste millions of lines of code.
Definitely not. You have to essentially rebuild the tracks while the trains are still running at 100 miles per hour.
Right.
And that creates what the CFO, Ravi Inukanda, called redundant tech costs.
Because you're paying twice.
Exactly. You're paying to keep the old lights on the server costs, the maintenance, the security patches, while you're paying a fortune to build the new wiring simultaneously.
That perfectly explains the expense side of the miss. But is it worth it? Or is this just, engineers wanting shiny new toys to play with?
The payoff they're looking for is developer velocity. Once this replatforming is done, they can ship a new feature, say, a better algorithm for handling grocery substitutions, and it instantly works in San Francisco, Berlin, and London.
They don't have to build it 3 separate times.
Exactly.
So they are eating the pain now to move much faster later.
That's the core strategy.
Right.
And speaking of moving faster, we really have to talk about what they are actually delivering. Because if you look at the growth numbers, it's not just burgers and fries anymore.
No, it's not.
The new verticals, which is what they call grocery and retail, seem to be the real engine right now.
And this is the part that I struggle with personally. I use DoorDash for food, sure, but grocery. Every time I try to order groceries online, I end up with a bruised banana, or they substitute my Greek yogurt for sour cream.
It happens.
It feels like a premium service for a subpar experience. Am I just an outlier here?
You aren't alone in feeling that way, but the hard data suggests consumer behavior is shifting really fast. In December, 30% of their global monthly active users engaged with the grocery or retail category.
1 in 3 users.
Yes,
That is way higher than I expected.
it is. And the CFO was very clear on the call. The goal is to get that 30% up to 100%. He wants every single user on the platform to be buying retail goods.
Wow.
But here is the real aha moment regarding your bruised banana point. Management stated they target grocery and retail to be unit economic positive in the second half of 2026.
Okay, let's break that down for a second. Unit economic positive. That means they actually make money on the specific delivery transaction itself.
Correct. Before they pay for the corporate headquarters or the R&D, the actual transaction of picker grabs item, driver drives item to your house is profitable.
Which is huge because historically, in grocery delivery, that has been almost impossible.
Right.
It just takes so long to walk the aisles and pick the items.
Exactly. Picking out 50 individual grocery items takes an hour. Picking up a stapled bag of Chinese food takes 10 seconds.
Right. So how are they making it profitable?
They're solving it through efficiency and basket size. Basket sizes are getting much larger. People aren't just using it for the emergency midweek run because they forgot eggs. They're starting to do their full weekly shop on the app.
So if I order $150 worth of groceries, the delivery fee and the commission they charge the store actually cover the cost of the driver's time.
Yeah.
Whereas if I order a single tube of toothpaste, they lose money.
Precisely. And to support this shift, they're getting deep into the physical infrastructure. They launched DashMart fulfillment services.
What is that exactly?
So they aren't just sending a driver to pick up items from a local Kroger. They're actually warehousing inventory for partners like Kroger and CVS.
Wait, so they are basically becoming the back room for these retailers.
Essentially, yes. They hold the stock in a dedicated DashMart warehouse so they can offer same-hour delivery that rivals Amazon.
That's wild.
It allows a CVS or a Kroger to compete on speed without having to build their own massive courier and warehouse network.
And this connects right back to that phrase we started with, operating system for local commerce.
Right. If you listen to Tony Zhu, he doesn't talk like he's running a consumer marketplace. He talks like he's building utilities. He wants to digitize every physical business in your town.
It's really interesting because when you dig into the earnings report, they are touching parts of the business that have absolutely nothing to do with delivery. I saw they mentioned 7 rooms.
Yes, Seven Rooms is a reservation platform they integrated, and the number of venues signed up increased 100% year over year.
Double the venues.
Think about that. This is about managing the in-store experience. You book your physical table at a restaurant through DoorDash's infrastructure.
So they get you when you stay home and order delivery, and they get you when you go out to eat.
Exactly. And then there's Symbiosis, which is their ad platform. The number of partners doubled and the ad spend tripled. They are helping merchants run their advertising.
Unbelievable.
And then there is Storefront, which is a tool that helps restaurants run their own e-commerce websites independently of the DoorDash app.
So the vision is whether a customer walks in the front door, orders on the restaurant's own website, or orders via the DoorDash app, DoorDash is quietly powering the transaction in the background.
That is the ultimate goal, to enable any physical business to become an omni-channel business. They want to be the weapon that small and medium businesses use to fight the massive retail behemoths.
Which brings us to the futuristic stuff. Because if you want to fight the behemoths like Amazon or Walmart, you need high-tech weapons. And DoorDash is going very heavy on autonomous vehicles and AI.
You really are.
We've heard about delivery robots for years, but is this actually real now, or is it just a cute PR stunt for investors?
It is very real, and it's scaling up. They confirmed on the call that they are doing live autonomous deliveries right now,
Yeah.
and they introduced DoorDash Dot, which is a robot specifically designed for the suburbs.
Why the suburbs specifically? I always assumed robots were a city thing, like navigating sidewalks in Manhattan.
Cities are actually much harder for robots. You have dense crowds, unpredictable curbs, complex traffic, construction. Suburbs are spread out, the sidewalks are generally clearer. It's a much more controlled environment.
That makes sense.
But here's where it gets really interesting. Tony Zhu made a point that the secret sauce isn't the robot itself.
Really?
Yeah, anyone with enough capital can buy a robot. The real secret is the orchestration,
Orchestration, meaning what exactly?
meaning the software brain that decides who gets the job. Think about a complex scenario. It's raining heavily outside. The customer's 3 miles away. They just ordered hot foo soup and a pint of ice cream.
Okay, that is a nightmare order for a delivery driver.
Right. Now, a drone can't fly in heavy rain. A sidewalk robot moves at maybe 4 miles per hour by the time it gets there. The soup is cold, and the ice cream is completely melted.
So you have to send a car.
You must send a human in a car. But what if the order is just a phone charging cable from Best Buy, and it's a beautiful sunny day?
Then sending a car is overkill.
Exactly. Sending a human driver in a 2-ton vehicle for a tiny cable is a massive waste of money and gas. The robot is perfect for that. The orchestration layer is the software that makes that exact decision instantly, millions of times a day across the globe.
So the competitive advantage isn't having the robot fleet, it's knowing exactly when to use it versus a human.
Exactly. That orchestration layer is the moat. It's the thing that's incredibly hard for a competitor to replicate.
Speaking of moats, let's talk about the elephant in the room, AI. There was a fantastic question on the earnings call about agentic commerce. Basically, an analyst was asking, hey, if everyone has a super smart AI agent on their phone by 2027, won't I just tell my AI to get me a burger and it bypasses the DoorDash app entirely?
This is the agentic commerce debate, and it is arguably the biggest existential question in tech right now. And Tony's answer to it was, well, it's a pretty harsh reality check.
What did he say?
He basically argued that AI chatbots or agents are just the new version of Google search. They sit at the very top of the funnel.
So the AI might help you decide what to eat or find the best price, but it can't physically get it to you.
Precisely. Tony said, and this is a crucial point to understand their strategy, that the digital world is easy. Moving digital bits is easy. But the physical world is messy. Moving atoms is hard.
It is. Drivers get flat tires, restaurants run out of guacamole, customers give the wrong gate code to their apartment complex.
Right. He called it the end-to-end job. An AI chatbot lives on a server somewhere in the cloud. It can't call the local restaurant and negotiate a substitution because the fryer is suddenly broken. It can't tell the driver to go around to the side door because the front path is flooded.
DoorDash owns the physical logistics network that actually solves those real-world problems.
That is exactly it.
That is a really strong point. Until the AI literally grows legs and can stand there and argue with a store manager, you
Okay.
still need that physical logistics layer.
Exactly. DoorDash manages the mess. And the more digital agents there are out there ordering stuff autonomously, the more valuable the company that actually moves the physical stuff becomes.
So let's look ahead. We've established the vision is huge, the tech is getting there. What does 2026 actually look like for them financially? Because as a listener, why should you care about their financial guidance?
You should care because it tells you if the company's grand vision is sustainable or if they are just going to have to jack up your delivery fees to survive the year. The guidance suggests a J-curve for the year. Q1 is going to be a bit soft.
Because of the winter storms we mentioned and that heavy tech spending for the replatforming?
Right. The hangover from storms Gianna and Fern, plus the front-loaded investments in the Deliveroo integration. But they expect profitability to ramp up significantly in the second half of 2026.
Because that's when those new verticals, the grocery and retail, are supposed to turn profitable on a unit basis.
Exactly. As grocery turns positive and those Deliveroo tech efficiencies finally kick in, the margins expand. They expect overall EBITDA margins to be up slightly for the full year. And, just to show Wall Street they are confident, the board authorized a massive $5 billion stock repurchase program.
$5 billion. That is a massive number. Usually fast-growing tech companies like this hoard their cash. Why give it back to shareholders?
It's a huge signal. It signals they believe they have plenty of free cash flow. They are saying they can fund all these crazy robot projects, rebuild their entire global tech stack, and still have $5 billion left over to buy their own stock because they fundamentally think it's undervalued by the market.
That brings a lot of stability to the consumer side, too, especially the Dash Pass subscription. If they were bleeding money, I'd worry about those subscriber perks vanishing.
Dash Pass is really the engine of the whole consumer business. They had record subscriber additions in 2025, and the data shows very clearly subscribers retain better and they order more frequently.
It's the classic flywheel.
It is. Once you pay that monthly fee, you psychologically want to get your money's worth, so you stop even looking at other delivery apps.
So, putting it all together, DoorDash is in this massive transition phase. They aren't a cash-burning startup anymore, but they clearly aren't just resting on their laurels either. They are aggressively spending capital to build this global automated logistics network.
That's the perfect summary. They are eating the heavy costs right now. The tech integration, the autonomous vehicle R&D, to completely own the infrastructure of the future.
Yeah.
They want to be the invisible plumbing for absolutely everything you buy locally.
Which brings me to a thought I've been mulling over while reading through this report. And it's a bit of a darker thought for the local businesses they serve.
Oh.
If DoorDash succeeds in this vision, if they truly become the operating system for local commerce, they handle the table reservation, they handle the digital ad you see, they handle the physical delivery, they even warehouse the goods in a Dash Mart.
They own the entire customer relationship at that point. The customer is loyal to the DoorDash app, not necessarily the local pizza place.
Exactly. So do the merchants eventually just become ghost kitchens, even the retail stores? If DoorDash owns the digital interface and the physical logistics, does it even matter whose name is on the sign above the door?
That is the multi-billion-dollar question for the next decade of retail. If you're a merchant today, DoorDash is your absolute lifeline to growth. But it might also be the exact thing that slowly makes your brand invisible to the consumer.
Right. You just become a node in their network, a silent fulfillment center for their users.
It's the classic platform dilemma. We will definitely be keeping an eye on that dynamic and checking to see if that Dot robot starts delivering our grocery orders later this year.
I'll definitely be checking the app and trying to see if I can get a robot to bring me a banana without bruising it. Thanks for listening to this deep dive into DoorDash's Q4 2025 earnings. Check your own app, see if you can spot the new retail options in your neighborhood, and we'll catch you on the next one.
Goodbye, everyone.